So I want to talk about using debt in a business. And the reason why it's on my mind is I was reading an article from the Boston Strategy Consulting Group book on strategy. And this is by Bruce Henderson. And it's in the beginning of the book, which is a lot of stuff on very general strategy. And so it's obviously important to him and Boston Consulting Group as a whole. And what I thought was interesting is, I'm going to do a separate review of the article, and I'm not going to go into it on this, but it's just a general thought on using debt for most businesses. And the general consensus, theory of debt in a business is that there's an optimal combination of debt and equity for every business. And what that means is all businesses you should put actual investor dollars into them, equity, but there should also be a component of debt. And the reason behind that as a theory is that it's going to increase the overall return of a business, whether you formulate that by return on investment, return on assets, return on equity, however you want to formulate that in your particular business. And every business has a different method you should think about in terms of figuring out what's the return of investment on the business, just like a stock has a return on investment. But the reason debt is always going to increase your return, no matter what form you use, is because the debt principal is always going to stay the same because the lender isn't an owner of the business. So what I mean by that is, the bank, when they loan you $1,000, they don't get any of the upside, and they just get their interest. And let's say that's 3%, because that's kind of the world we're living in right now. They get 3% interest, and that's it. If your business doubles in size, their principal doesn't double. It stays the exact same if they loaned you $1,000. It doesn't go to 2,000, it stays at 1,000. They just get the interest, and they have a lot of downside risk, because what can a loan go to? It can go to zero. That's why, banks, when they lend, they want to lend against something, meaning have it secured. But that's a conversation for a different day. The general principle I'm going for is, because the bank doesn't participate in the upside, when you borrow, your upside is almost limitless on debt. So let's imagine that you borrowed 100% on your business. So you're starting a business for it costs you $1,000 to start, and you borrow $1,000, and you start your business without putting any of your own money in. And let's say the business gets worth $10,000 by whatever your return analysis is. You sell it for $10,000 or whatever. What's your return? Well, your return's infinite because you didn't put a dime into it. And that's, truly the power of debt, is essentially limitless returns on the amount you borrow. Your return's infinite. You do have an interest cost, which is going to reduce your return. But, as long as your business is growing in a rate in excess of interest, that's all upside to you without any investment on your part. Okay, so why wouldn't you borrow 100% all the time? Well, number one, the bank's generally not going to loan to you 100%, particularly if you're a small business. They want to see that you have some skin in the game, meaning you have something to lose. Because again, the bank, when it loans you $1,000, it can get 3% interest, or whatever the interest is, in today's market. So, on $1,000, that's what, $30 a year of interest. Well, that's not much upside for the bank, although the banks can borrow from the federal government essentially nothing, so maybe their returns are almost limitless. That's not quite true. But they have a lot of downside because they can lose that $1,000 if they don't have it secured. So your ability to borrow, especially as you're a smaller and smaller business, is going to be limited. And, if you're borrowing against your home or something like that, in reality, that's not, because you're personally liable for it, it's not the same as when a publicly traded corporation like issues a bond and gets a loan that way, or when they borrow from a bank, because you're 100% at risk. So I'd view that as, when you're securing your borrowing with personal assets, it's almost like you're putting your own money in there, but it's a double risk because you could go to zero because your business could blow up, and then you could still own the money. So that's kind of double downside, and we'll get to that in a minute. But getting back to my capital structure discussion, the general theory is there's some measure of equity and debt that is optimal for a business. And the equity portion, I talked about why it's not 100% debt. It has to be some equity because at the very minimum, you got to have, the bank's not going to loan 100%. The investors, the owners of the business have to have some skin in the game, even a publicly traded company. But, equity is important also as a risk reducer. And let's look at it, this is the easy way to think of it is, and this is, where I come from too, because I own single family homes as an investment. I have different amounts that I've put in to different single family homes. One of them, I have 100% equity, meaning I bought the house for cash. There's another one, 50%, and a couple that I did 25% down. What's important is that determines how much of the rent that I get to keep. So, for the one where I put 100% down, I keep all the rent. For the one I put 50% down, I keep half the rent. And for the one that I put 25% down, I keep, about 25% of the rent. But then I got taxes on that, and I got insurance costs. And when you get all done with it, the ones where I have 25% down, I really only take home a couple $100 a month out of, the rents. Those rents are in the range of $1,500. Whereas, when I take home 100%, after I pay my insurance and taxes, I still have a lot of money. And I'm getting enough money every month that I'm building up a savings and a reserve. So if I lose a tenant for 3 months, that's not a big sweat off my back, because number one, I don't have to pay any interest. I don't have any mortgage to pay on it. So it can just sit there and I just got to pay the taxes. And number two, I have a big savings from which to pay those taxes from, related to that account, that property. Now, my 50% loan to value property, it's a little worse if someone gets out there, because I gotta pay 50% worth of mortgage. My mortgage is half as much as it would be if I did 100% down, but I still have a lot of cash flow on that one, and I'm building up a reserve, and you combine it with my reserves in the other one. I really reduce risk, because if I lose a tenant because they don't pay, I got to evict. Say no one's in there for 3 months. Well, I have enough of a reserve that got built up quickly that I can go ahead and cover that, and it's not a big deal. My 25% downs, well, that's kind of a little more risky of a proposition, because if I don't have someone in there, I owe a great deal of mortgage. I owe a larger mortgage as compared to the rent that I get every month. So if I lose a tenant and I don't replace a tenant for 3 months, I've got a big nut to cover for those 3 months, and I'm going to seriously dig into my reserves. So that's a question of risk. In the 100% equity house that I have, where I bought it for 100% down, man, there's really no risk, because even the taxes are so minimal relative to the rent that I get, that if there wasn't anyone in there for a year, the taxes would be less than a month's rent. The 25% downs, man, if I don't get someone in there for 3 months, I'm not going to be sweating it, but it's going to hurt a little. And that's a measure of risk. Now, if I was 100% loan to value, meaning I borrowed 100% of the purchase price, well, basically all of my rent would go to pay the mortgage. And maybe I'd even have to chip in a little after that. But let's say 100%, I wouldn't earn any cash flow. And the problem with not earning any cash flow because you borrowed so much is when things go wrong, you are going to be hurting bad. And in my portfolio of real estate, when you look at them all together, I'm at about a 40% loan to value. And that means that I'm generating enough cash flow that I'm tucking away that I can stand if I can cover it if there's not a renter in one of my properties. And in addition, I can cover it from my other properties where I still have cash flow. It would have to be a really weird situation for me to have all of my properties not firing at one time. Well, take that if I only had one property. If I only had one property and I was 100% financed and there was no tenant there, I'd be scrambling, okay? If I had 10 properties and I was, say, 25% down on all of them, 25% equity, well, if one of them went out, I would be able to cover it from the rent from the other properties. And that's where I'm kind of going with this with regards to using debt in business is the smaller your business is, really the more I think you should be at 100% equity, because you don't have enough scale to deal with things going wrong, and you don't have enough margin, meaning margin of safety in your business. And when pundits talk about capital structure in businesses, a big mistake people make is applying what's good for Apple or what's good for Amazon, or even what's good for a smaller publicly traded company or a large private company to kind of a mom and pop, shop that can't make their payroll or can't make their rent if the coronavirus strikes and you aren't able to run your business for a month or two. And the coronavirus is an important lesson for small businesses that you cannot rely on debt. I don't think it's a good idea because there's so many risks. The coronavirus is one, but there's a lot of other potential risks that can leave you severely underwater and hurting when things go wrong. Publicly traded companies in the coronavirus, they shuffled things around. They issued bonds. Revlon just restructured some debt because they've been experiencing some problems. They've got a lot of options. When you have scale, you have options. The smaller you are in the food chain, the less options you have, and the less that I think you should be thinking about using debt at all. So you can sit there and, as you go through, what is my correct capital structure? Man, unless you've got serious reserves and unless you're making, say profit-wise, this is going to be a gross generalization, but I'm going to make it anyway. Unless you're making, $500,000 plus a year, it's very difficult for me to suggest that you borrow money unless it's directly secured by income producing assets. Because if you're borrowing money in a business, you're probably personally guaranteeing it unless your business is large enough. And that, as I said earlier, is a complete disaster because if things go wrong, not only do you lose your income stream from producing the business, you still owe the debt. The reason I'm comfortable in my single family homes is I have an asset that secures that debt that I can always sell if things go bad. My 100% finance property, I don't owe anything. So if I sold that, I'd get 100% of the proceeds. But even the 25% down ones, they've appreciated in value since I bought them. And there's enough equity in there that it would be very, very difficult for things to go wrong. And I think you should think about it the same in a business. And maybe an easy way of thinking about that is, say you're a franchise business and you own a franchise restaurant. Let's pick Subway. Your first restaurant that you do, when you don't know what the return's going to be, you don't know how successful it's going to be, I don't think you should borrow money personally. I think you should come up with the equity yourself and make sure that business actually runs well before you start borrowing money on it. Maybe your second location, you go 50% down, and maybe as you get into your 10th, 11th, 12th locations, then you can start worrying about, putting less down and leveraging more, because it's true, your returns are just going to be higher, and that's true. But at the same time, your risk is going to be greater, and you better have a series of income producing assets where you know how much they're going to produce on a consistent basis before you start borrowing significant dollars. And in our business, frankly, we're a gigantic business and we don't borrow anything. And I'm totally comfortable with that as a CFO because our shareholders are comfortable with it and they understand their returns are lowered because of it, and they're fine with that because it eliminates risk. So I always think you should always at least consider a zero debt capital structure. And I don't think CFOs in publicly traded companies or private equity owned companies, they don't have that luxury because they have return expectations to meet, and there has to be leverage in order to meet those return expectations. But if you own your own business, man, I really think you should think about doing it on a completely debt-free scale. Maybe if you borrow money to buy your building or something like that, because it's an asset that you could sell if things went wrong, that's okay. But the worst thing that you can do as a business owner is acquire personally guaranteed debt, where if your business goes under, you not only lost your business, but now you're in debt as well. So in sum, I think whenever you see high level talk about capital structures in business and how much debt is appropriate, you need to distinguish when they're talking about publicly traded companies where debt is absolutely required, can be borrowed a lot cheaper than you can borrow it, and is not personally guaranteed by anyone. You can start thinking about the infinite returns that are available with debt when you're at that level. The further down the business food chain you are, the less I think you should even be thinking about debt, because it adds such an element of risk that it's just not worth it. And I think the coronavirus is really driving that point home. And, my recommendation is, businesses, unless you're making $500,000 plus a year minimum, I really think you should think about not borrowing at all. And you certainly shouldn't borrow until you have a reasonable expectation of what your returns are going to be on a consistent basis. And returns meaning revenue that's well diversified by either products, location, different distribution channels, etc. You need to be diversified enough to weather the loss of a customer, the loss of a distribution channel, etc. So that's my thoughts on debt, and just want to remind business owners to be very careful when you think about going out there and borrowing money. You're not a private company, and the risk is very great. So, hope that helped.